This is the Wall Street for Main Street radio podcast, your number one destination for financial news, information, and education with no strings attached. Be sure to check out our other podcasts and articles at www.wallstreetformainstreet.com. Now, here are your hosts, Jason Burek, Mo Dawood, and John Manfreda.
Hi everyone, this is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. He's joining us from Toronto. He is John Ciampaglia. He is the Executive Vice President of Corporate Development. He's the head of ETFs at Sprott, and he's also a chartered financial analyst. Thank you for joining us, John.
Thank you.
Now, John, let's talk about ETFs. I worked as a stockbroker for a little while. I tried selling mutual funds. They were not an easy sell. They're high commission products. I think a lot of retail investors are getting fed up with them. They're learning that, these things don't allow you to keep your dividends and compound. Why did Sprott decide to get into the ETF business?
Well, the ETF marketplace has grown by leaps and bounds over the last 15 years. And it's been quite, we've been quite amazed by the adoption. And the adoption is really unique because it's not just individual investors. It's, everything from individual investors to financial advisors right up to the most sophisticated pension funds and sovereign wealth funds in the world. And the unique value proposition that ETFs provide people is that they provide everyone with equal footing. Everybody gets the same price. Everybody has the same transparency of the holdings, the methodology. So the ETFs really level the playing field for all types of investors, which make them very appealing. We think that there's a couple of big drivers behind the ETF growth. One is ETFs that are being used as substitutes for stocks. In the past, we saw more individual investors and advisors picking individual companies. Increasingly, we see a shift away from that, where investors are opting for a more basket approach. And an ETF provides a very convenient, low-cost way to gain access to a diversified basket of stocks. I think the second thing that's happening is that for some active money managers who are not adding value in their stock selection and active methodologies, investors are basically firing them. They don't want to pay the fees anymore for marginal investment performance. So you've seen a shift away from some active into passive and enhanced indexing strategies on the ETF side.
Yeah, I think mutual funds are dinosaurs. I don't know if you've looked at some of the studies for some of the mutual funds, but a lot of these mutual funds, they drastically underperform their benchmark. And the reason is quite simple. They have all these overhead expense fees and commissions and all these other things, and they're just not very efficient. But when all these stocks were in when these different sectors of the economy were in a bull market and everything was going up, most people didn't notice. But, as we've had these stock market crashes, 1999 with the technology bubble and in 2008, people, after their losses, they start to look more closely at the investments they had and they notice, hey, wait a second, this mutual fund is stealing, I think stealing is a harsh word, but but this mutual fund is getting 2% of my assets every single year sometimes in fees, and this ETF is charging a much lower expense ratio, and I'm very diversified with this ETF, and it's just a market solution to a problem where there was a market inefficiency, and people like Sprott and other companies decided, we can offer the retail investor an opportunity to keep more of their capital and also be diversified.
Yeah, well, I don't know if I completely agree with all of those comments. The mutual funds, do serve a purpose in the marketplace for many investors, but I think what's happening is that investors want to have choice, and increasingly what you're seeing is that investors are using both solutions side by side together. In some cases, it makes sense to have active. In other cases, it makes sense to have passive. And increasingly, they're being used side by side. But I think you raised an interesting point, and that was each time there was some kind of calamity in the marketplace, whether it was a tech bubble bursting in 2000 or the financial crisis in 2008, we saw an increase in usage of ETFs after each of those periods. And we believe, and I think the market consensus out there, is that after those events, people demanded a higher level of transparency with their investments. They wanted to know every day what they held in their account, like what the fund held. They also wanted to know that they could trade their ETFs intraday versus once a day for a mutual fund. They also wanted to understand the methodology of how the securities are being picked. So for some investors, those differentiators had increased appeal following those financial events.
Yeah, I think those are valid, and like I said, the financial crisis definitely woke more people up, because if people had an individual retirement account in the United States, an IRA or a 401k here in the United States as well, or they were a teacher in a pension plan, as long as their account was going up every single day, John, I don't think they cared that much about the fees and the expense ratio nearly as much as they should have. But, once those things started to go down a lot and we had those market crashes, then they started doing more due diligence. Obviously, they probably should have, in hindsight, they probably should have done more due diligence before they bought those investments. But I don't know about Canada, but I know there's limited investment options for a lot of people in their 401ks, which is unfortunate.
Yeah, with respect to our involvement with ETFs, I mean, we have a couple of now, and really we got involved in these ETFs because we felt that as a firm, we could provide different solutions in the marketplace to meet unmet needs. There are a couple of very large gold mining ETFs out in the marketplace today. We use those ETFs as active managers from time to time over the years, mainly to equitize cash. What we found is that a lot of the companies that are held in those indexes, we weren't really fond of as active fund managers. And, for example, in the senior mining sector, what we find is some of the largest companies by market cap, have been among the largest destroyers of shareholder wealth. They also tend to be among the most indebted, and they also have the largest challenge, which is every day, a mining company shrinks its assets and it has to replace those assets with new assets. And for a larger company, it's just a lot of large numbers. It's just more difficult to do. So when we started to think about how we could come up with a different index methodology, we thought, what are the factors that matter to the senior mining sector? What can we do differently to try to provide a different return profile with our index methodologies? So we partnered with a company in Chicago called Zacks Index Services, and we co-designed our two indexes with them, really leveraging the experience and the expertise that we have in the mining sector. Being in Toronto provides us a very unique perspective. It is the mining finance capital of the world. So over the years, we've had many, many mining companies that we've met and helped finance. So we know a lot about the inner workings of the industry, and we really wanted to put that know-how to work when we designed our indexes, which we think are very differentiated in the marketplace.
Now, in terms of your index methodology, we have these other gold mining ETFs, which is the GDXJ, and the GDX, is the larger one. Those indices, they tend to be market cap weighted, right? Most ETFs and indexes are market cap weighted. How is the Sprott gold mining ETF different?
That's right. The vast majority of the current methodologies in the marketplace are market cap weighted. And that simply means that you weight a particular stock in an index based on its market capitalization. So the larger the market capitalization of a company, the larger its weight in an index. To us, that's a very simplistic approach. We like to think of that as a quantity-based approach. When it comes to gold mining, it is a very difficult sector. It's obviously going through a very difficult restructuring right now, and it's also trying to heal itself from a bunch of self-inflicted wounds that it imposed on itself over the last few years. Our methodology tries to focus on quality versus quantity, and what that really means is we're trying to find companies in the investment universe that we think have greater investment merit. So what does that mean exactly? Well, we're looking for companies that we think are the best positioned long term, and we're looking for factors, company factors that we think are good predictors of long-term performance in a sector. So, for example, among the senior mining companies, one of the factors that we use to help weight the index is revenue growth. And, I think for the average person, they would say, yeah, that makes sense. You obviously want to invest in companies that are growing their revenue. Well, for gold mining companies, this is really critical because we want to know, are they having success with their mines every quarter? How much gold are they pulling out of the ground? If a company is having challenges with their mines, it's going to reflect in their revenue on a relative basis to their competitors. It's a very important measure because it's a clean accounting measure of their production growth. So our methodology is trying to find the companies that have the best relative revenue growth. And, gold has gone through a pretty tough down cycle here. And a lot of companies, their revenues have declined and their production has been declining. Having said that, there's still lots of companies out there that have, fairly stable revenue relative to peers. And that's what the index is trying to find right now, is those companies that are faring better in this downturn. So a company like Franco-Nevada is one of the top holdings in our index right now. It has had relatively stable revenue relative to some of the traditional miners. Another top weight would be Rand Resources, where it's been able to grow its production by over 20% last year. That's another large weight in our index. And the second factor we look for is long-term debt to equity. And what that basically is trying to find is companies with stronger balance sheets. Gold mining is very capital intensive. It costs billions of dollars to find, develop, and create new mines and put them into production. And we really want to focus on companies that are not over-levered, that are better positioned to weather downturns. We also find that companies that are highly levered, obviously, are making large interest payments to bondholders, which erodes their profitability. So our index methodology will emphasize companies with better relative balance sheets. So companies like, again, Franco-Nevada, which has no debt, Randgold, which has no debt. And on the flip side, it'll penalize companies with a lot of debt on their balance sheet. So Barrick Gold, for example, has about 80% long-term debt-to-equity ratio. The methodology right now will say, well, we don't like that, so let's underweight that company. I think the other important thing about our index methodology is that it's dynamic, which means it's not just a one-time set it and forget it. It looks at the companies every quarter, the latest financial results that they produce, and we reconstitute the index every quarter. So if a company is starting to decline or deteriorate, it will be penalized in our methodology. And on the flip side, if a company is improving, it's reducing its debt, it's growing its revenue, the model will recognize that and allocate more weight to it. So we think that is a very valuable added feature for investors because it is a dynamic process and it's happening every quarter for them.
Yeah, and you guys are having a lot of success so far with the total assets, right? You launched the Sprott Gold Mining ETF over the summer of 2014, and I think I read an article that Sprott released this week, or last week it was, and Rick Rule and you said in the interview that ETF already has $180 million in assets under management?
Correct, yes. We've been very happy with our entry into the marketplace. We've been very well received despite a very challenging environment. And I think that's a testament to the acceptance we've had in the marketplace with respect to our alternative indexing methodology. Especially in an environment where the sector is still trying to sort itself out, a quality-based approach with our index methodology intuitively makes sense for most people that we talk to about it.
Yeah, it definitely sounds a lot more efficient, and the regular GDX is most of the holdings in the GDX are just Barrick Gold and Newmont Gold, and those are large bloated companies. I think if you've looked at the production growth for Barrick, I mean they've struggled to grow production without debt. They made some bad copper acquisitions. They bought a copper deposit, in 2011 for I think $7 billion, and they just sold it at a huge loss for $1 billion. And Newmont, I think Newmont's gold production is actually contracted. So, even though Newmont's kept their dividend. So, these old versions of ETFs, it's good that you guys are being entrepreneurial there and starting to challenge the old guard there of the ETFs, because, some of these ETFs, as good as ETFs are, in my opinion, compared to mutual funds, some of them are just highly inefficient.
Yeah, I think you have to look at it on a case-by-case basis and ask yourself, what are the potential shortfalls of market cap weighting a particular sector. And right now, with the gold mining sector being so divergent, meaning the mixture of quality is so wide right now, as we have a number of companies that are trying to reinvent themselves or restructure in the current gold price environment. We think it's incredibly important right now to really focus on the companies that are in a better financial position to succeed long term.
Yeah, I agree. I think there's a lot of good bargains here, and for people who don't have the know-how or the capital to be buying individual stocks, I think ETFs make a lot of sense, and you guys have a good one there with the Sprott Gold Mining ETF. I think it's very good. Now let's talk about your newest junior gold mining ETF. What made you decide to want to launch a junior gold mining ETF in the height of a bear market?
Sure. Well, I think if you talk to Rick about it, he thinks the best time to launch these kinds of offerings are when you are in a bear market, because a lot of the risks have been wrung out of it. The sector, as you know, has been absolutely pummeled, down 85 to 90% since peaking in late 2010. So it's not for the faint of heart. It's still a very volatile sector. But we think, again, for someone interested in junior gold stocks, picking individual names can be really risky, because they require an enormous amount of technical and management due diligence. We have parts of our business that do that professionally for people. But if you don't have the professional assistance, we think that using an ETF as a stock substitute is a viable option for people to consider. When we designed our the Sprott Zacks Junior Gold Miners Index, we really wanted to take a different approach, because, again, the sector is so different. The first thing we did when we designed this index was we wanted to focus on later stage, more advanced companies, because our belief is that even a rules-based indexing methodology would not be able to properly evaluate early-stage microcap companies. So we generally do not have those companies in our index. That's the first big difference. The other thing we wanted to do was have companies with slightly higher market caps than some of the existing products in the marketplace, because we want our index to be more liquid and more investable and scalable over time, because these are small cap companies that aren't the most liquid, and any kind of changes to the index constituents can cause a lot of price distortion. And we noticed it happening on a regular basis when some of these larger ETFs rebalance their holdings. It can really move the share prices either up or down. So we believe that focusing on larger market cap companies within the universe is kind of the starting point. Then we wanted to weight the companies very differently. We wanted to focus again on the revenue growth, because we felt as though the real value created in the mining space wasn't from the initial discovery, but it was from bringing that discovery into commercial production. So we want to bias our portfolio holdings to companies that are actually producing revenue. And we think that allows the portfolio to be de-risked, because a lot of the unknowns, whether it's grade or feasibility or permitting or whatever those issues are that an early stage mining company is trying to work through, have been removed out of the equation. So we tend to focus on larger companies. They tend to be more revenue-oriented. That doesn't mean a company without revenue cannot be included in our index methodology, but it won't be rewarded as well. The second thing we're looking for is price momentum, and price momentum is basically a pricing anomaly in the marketplace that's been well documented in many academic studies. That basically says that companies with strong stock prices tend to continue to have strong stock prices, and conversely, companies that have weak prices tend to continue to be weak. In the junior gold mining sector, we think this factor is quite relevant because what price momentum is really capturing here are all the positive developments or negative developments happening at a company. So, for example, if a company is displaying a lot of positive price momentum, that could be because very good drill holes have been announced. It could be a successful financing or joint venture, permitting, receiving permitting. And on the flip side, when you think about a stock with really weak price momentum, it's usually the inverse, which means the drill results are not good, something very negative has happened, and the stock is really falling sharply. What we find in our research is that companies with the weakest price momentum tend to be the most volatile, and obviously people are not looking for the most volatile investments. So with our index methodology, what we do is we try to overemphasize the companies with the highest price momentum and de-emphasize the companies with the weakest price momentum. So for each of these different segments, we look at different factors because obviously the stage of development of these companies are very different between a senior and a junior gold mining company. And as with the senior index that we have, the junior index rebalances as well, albeit we do it twice per year, not quarterly. We found that in our research that doing it twice a year was sufficient, and we didn't want to rebalance the portfolio too frequently, given these are smaller, less liquid companies.
That's very interesting. And the junior gold mining ETF that just launched in the last couple weeks, right?
Correct.
And it's on an American exchange, so the U.S. retail investors can go buy that right now?
Our ETFs are listed on the New York Stock Exchange ARCA and are available to anyone that can access those ETFs.
Are you also, John, in charge of the Sprott Physical Metals Trust?
No, but I do assist with those products as well.
Is there still a lot of popularity among those? Are there a lot of contrarians buying shares from what you're hearing in the Sprott Physical Gold Trust, the Sprott Physical Silver Trust, and the Sprott Physical Platinum and Palladium Trust?
Yeah, generally, yes. We see pretty good daily buying activity on those products. Again, we think they provide a differentiated value proposition for investors. They do have a unique feature that has the gold stored outside of the financial system with the Royal Canadian Mint. We also have 100% fully allocated metal. And there's also a tax difference between, for certain U.S. investors that qualify, the funds can be taxed at either 15 or 20% capital gains tax rate versus other traditional gold ETFs that are taxed at the collectible tax rate.
Very good. Yeah, and people can take physical, if they have enough shares, right, they can take physical delivery of their metal.
And that's also an option for qualifying investors.
Very good. Well, I really like what Sprott's been doing here with trying to help the retail investor get more exposure to juniors because, normally Sprott, like you said with the juniors, you need a technical team, geologists, metallurgists, things like that. You're a CFA, you need to know the financials. There's a lot of these juniors that have put out pre-feasibility studies that are not economic at these levels, and yet, they're still trying to raise capital in these markets. I'm sure Sprott knows this because they're trying to get to them. But, Sprott's company gets access to private placements and stuff, and the average retail investor can't really get access to that. So I think this ETF will give them a chance to, the new junior gold mining ETF will give them a chance to pick out some of the, to have exposure to some of the higher quality juniors.
Yeah, I mean, we like to think of our indexing approach as a more thoughtful way to invest in the sector, which, as you know, is very volatile, and is a better solution than trying to, pick individual stocks without a lot of, guidance from the professionals.
Yeah, the average retail investor doesn't have much of a good chance if he doesn't, have a geological background, or he's reading, a newsletter from a geologist or something, or getting help from a broker at Sprott. He's just at a huge disadvantage to trying because of the technical expertise required to for drilling and bringing a deposit online. Well, John, I just want to thank you for your time today. Really appreciate it, and I wish the Sprott Junior Gold Mining ETF the best of luck. I think it'll do pretty well. I think gold is fairly close to a bottom if it hasn't bottomed already. And the juniors, they are volatile, but when the gold price bottoms and it starts moving higher, you get that higher leverage to the gold price.
Oh, we hope so.
Okay, great. Well, thanks for your time, John. I appreciate it.
Thanks very much, Jason.